if I can get the tenant to pay me money on this DSCR loan, I have the ability to ride this upside for the next 5 years and then flip it then and 1031 out of it.
Here's the reality. Half of the people in the United States will never buy an investment property. Another 40% will drag their feet until the opportunity is gone, or they're going to run into some roadblocks and give up. That leaves 10%. And that 10% is busy right now. Why? Because when rates drop, prices will jump. Just like during the pandemic, it's simple supply and demand. More buyers, same number of houses, capital is easier to get and cheaper to finance, prices are going to go up. So while the comment section is debating, the smart money is out there looking for deals. Today, Jason and I are going to show you why buying an investment property now isn't just for the mega rich. And we're going to give you 5 ways to get into your first investment property. Stick around because by the end of this, and it doesn't matter if you don't have a W-2, you'll either have a plan or a really good excuse. But before we move on, 95% of the people watching our videos are not subscribed. If you're enjoying the content and getting value from the info that we're putting out, there's no need to pay us. All we ask is that you subscribe to the channel. If you have contradictory information from your own research, please let us know in the comments and we can have a discussion. Welcome to the channel. We're the Clear Close, the mortgage experts that get you clear to close on your next mortgage. Hopefully, it's going to be your investment property. Quick TLDR. We respect your time, so don't buy a course from us or whatever. We don't sell that kind of stuff. You can just take a quick screenshot of this. This is basically what we're going to be talking about. And if you're really busy, you can come back to the video and watch it for the in-depth. All right, Jason, let's dive right into it. We're talking about the 5 best ways that people who are looking to get into an investment property can finance one. Right? Most people don't have $1 million, $500,000 to just buy outright cash. Unless you're a factory owner in China.
I mean, hey, if you are that factory owner in China or Korea, let us know. We'll help you. You know exactly the right programs to get you rental properties and a portfolio built up here.
Yeah, we'll get to that. That's gonna be one of the 5 that that's gonna be one of the ones that we talk about. So for the U.S. citizens, for the people here, for you watching at home, before we get into the actual meat of this, why do you want to buy an investment property? What are the benefits? Just off the top of my head, I'm thinking like cash flow benefits, right? The very popular thing that people want to do with their investment property is rent it out, whether it's a short-term rental like an Airbnb or a Vrbo, or it's a long-term rental.
For me, it's like I like seeing the wealth growth and net worth growth
Appreciation.
more than the actual
Yeah.
cash flow. Because if you have a really good job, not saying you don't, but then it's like if you chase the net worth, in my opinion, this is far in the future, you're going to get that cash flow.
Yeah, not just net worth appreciation, but protection.
I mean, as long as you're making the payments, you can support it. That's your house. That's your asset. It's like it's wealth. It's generational. You could pass that on. So as long as you have the right strategy and it meets your goals, there's so many ways to build wealth.
Right. There's also tax advantage benefits too, because the United States is a country that really rewards ownership, whether it's owning a business, owning property, owning stocks. You got to own assets in this country to get ahead.
Absolutely.
The last benefit is you can always access the equity and leverage against it. So Jason, you've helped people get to portfolios, but sometimes they're pulling out equity from one house, putting into a down payment for the next house, and then so on and so forth, right?
Yeah, it's multiple avenues. People take from the equity that they've built up over time. I'm not saying you leverage max to 80% every time you do it. That's a very, in my opinion, very risky way to grow a portfolio. But I have seen people who have successfully done it. As long as you have the right strategy, it's an amazing tool, especially with some of these loan programs we're going to go over.
All right. So the first one that we're going to cover is a traditional conventional mortgage. So this is for, you don't want to do any tricks, you don't want to do any hacks or whatever. This is just straight, like I'm going to put 25% down.
So, I mean, this loan that you're talking about is the conventional loan. It's the cookie cutter one that you see everywhere. It's the same loan program that you use to buy your primary home through Fannie, Freddie. So it's best for people that have like strong credit, steady income, a bigger down payment, and it delivers the lowest long-term rates and predictable payments, right? So it's again the vanilla version of real estate investing. Only downside with this one though is you have a maximum of 10 finance properties. So once you're going to hit a ceiling where you can't use traditional financing, aka the conventional loan, and you're going to eventually, this is where I meet a lot of people too. They don't realize that there's actually other programs out there that are the other four options we're going to be talking about to help you get it. But again, this is just the most traditional one.
You want to buy when there's a really good deal and the numbers make sense for you. Like we're not advocating just to like go buy something that's like completely out of your reach, just
Well,
in order to rent it
technically, you
out.
can't do that anymore because the lending laws are different. You actually have to be able to repay your loan. So
Yeah, yeah, you have
it
to show that you have the ability to repay. That's right. So that's conventional. Now let's look at the non-conventional ways to do it. So these are what we call non-QM, non-conventional or non-qualified mortgages. The first one up, something that we've talked about on the channel before, is called a DSCR, a debt service coverage ratio loan. Basically,
mhm.
what this loan is doing is allowing you to qualify for the mortgage based on the potential income that property can generate. So it's not what you're paying, it's what the tenant is paying.
Exactly. So it's that building or home is going to generate income and that gross revenue, right, of rents coming in versus the expenses to maintain that property. At the minimum, to qualify in these DSCR programs are the property taxes, homeowners association if it has it, homeowners insurance, principal and interest payments. And as long as you qualify within that specific ratio, typically 1.0 or higher, you're going to get some pretty good terms. And I have some options depending on the state too and your credit. Yeah, down payment could be anywhere between 15% to 25% or more. It just really depends on that specific home and its ability to service the debt, right? So that's the most important piece. It's very simple too because it doesn't involve your personal income. You don't need to do full tax returns. You can finance more than 10 properties. A lot of the restrictions from the conventional loan are stripped away, and we look at it more of it as a commercial loan. So if you've done commercial investing, you'll look at the ability for that apartment building or commercial property to generate revenue. And they took that concept and applied it to single family 1 to 4 unit homes. There's so many different DSCR loans. Like if you've watched our HELOC videos, like or if you've spoken to me on the phone, the only thing HELOC lenders have in common are the product name HELOC, because the actual underlying program can vary depending on lender and institution. The same applies for DSCR loan. Just because it's called a non-QM DSCR loan, it's not standardized like a conventional loan. There's thousands of different DSCR lenders out there, and all of them have different like caps, ratio requirements, appraisal processes, how they look at things, seasoning, how quickly you're turning over property. So just because one company said no doesn't mean it's a no for us as an example, because we have over 150 different lenders we've worked with that we've refined down to. I can show you the hundreds we've cut over the last couple of years for not like not living up to our expectations for service and like customer experience. And in some cases, if you're really well qualified, like 740 plus FICO score, 25% down, you're going to get pricing that in some cases seem better than primary home conventional home loans. It's absolutely insane. It's an amazing first step.
And I already know that you're probably typing in the comments, what's the rate? So before you finish that sentence, actually finish that comment, write the comment, it's fine. That helps the algorithm. But the rate is going to be depending upon multitude of factors. So if you want to talk about what your specific rate is for that particular house, click the link in the description below. Talk to Jason, talk to Nikki. They can give you guys guidance on the rate that you're qualified for, basically, or for that property qualifies for, right?
Absolutely. There's no obligation, right, to get a quote from us. And if it's something we can't do or it's not up our alley, we'll find someone to refer you to that can help you, right? It doesn't, when it comes to real estate, it's all about networking. So it's the relationships. So if I can't help you today, there's no harm, no foul, right? Because that's my job. I'm here to help. So if I can, I will. And if I can't, I'll let you know, go somewhere else.
Okay, let's move on to the next one. This is called a fix and flip loan, or otherwise called a hard money loan. So, Jason, what is the fix and flip loan kind of, what is it best used for?
So fix and flip is like a term, but the underlying program is basically a bridge loan. So it's a short term note, just to be clear. It's like it usually due within 12 to 24 months. So, and it's a balloon. What you have is the ability with this fix and flip or rehab loan, the ability to purchase and rehab that property all in one loan. And it's lent to you based on the after repair value, the ARV. So it's more for people that have some experience because it's not an easy loan to get without experience. You have had rental properties, you've successfully maybe exited one or two fix and flips. Um, there are lenders out there that allow you to do these fix and flip loans with no experience, but you're going to be paying a pretty penny for it. But again, it gets you the funds to purchase and rehab quickly. And it's good for those that want speed and flexibility more than the lowest rate.
How do we get out of a fix and flip loan? Do we have to sell the house or can we refinance into something else?
They want you to get in it and get out of it as quick as possible. So one of the options that I see often is if they don't sell it, once it's renovated, they'll just immediately flip it into a DSCR loan. Cause like that's the easiest way, like in my opinion, if you find it. Cause a lot of clients, when I talk to them, they're like, oh my gosh, this is an amazing flip. And it's like I could walk away with like 100 grand in profit, but I have so much equity built into this now that like I think I could run up that in the long term, and I'll just hold it for 2 to 5 years, right? Instead. And in the meantime, since I have so much upside, I'll just collect the rent as cash flow. So I've seen that happen too, which is pretty amazing because some deals, it's like it looks really good as a flip. And then once you're done with it and you're like, oh, the cash flow is not bad. If I can get the tenant to pay me money on this DSCR loan, I have the ability to ride this upside for the next 5 years and then flip it then and 1031 out of it. That's where it's like, oh, you could hit strategically cash flow now and then equity and appreciation net worth right later. That's what the beauty of real estate is, because once you understand there's more than one type of loan out there, it lets you make really great business decisions to grow wealth. If you understand how to leverage properly and know what tools are out there, your real estate investing could change exponentially over the next like 3 years.
All right, let's move on to the next one. This is a product that we talk about a lot on the channel. It's a HELOC. Basically, you finance it yourself. You are your own bank, right? Like just as Jason likes to say a lot.
It's my favorite. Honestly, it's my favorite because it's the cheapest way to have your own renovation fund. Because now you're able to underwrite the deal yourself and say if this purchase price is good, and then this is my rehab value, and this is all it's going to take me to renovate it, and I could do it in 3, 6, 9 months, right? Like now you don't have to pay a fix and flip loan over and over and over again. You just get your HELOC and you reuse that during the drawdown period. Because typically on our programs, the most popular one, the 30-year note comes with the 5-year drawdown period. So you have 5 years if you got a HELOC for 2, 3, 400 grand to reuse that capital, working capital to acquire, rehab, renovate, flip, or turn it into a DSCR loan and hold it as a long-term property. That's that's the biggest game changer because I have a few clients that are actively using the HELOC that way, and they're building their portfolio faster and cheaper. You got to understand, like as a broker and a mortgage originator, we make money writing loans. So we're telling you, if you got the equity, do the HELOC to save you more money. So it's counterintuitive to our business where we would want you to do a fix and flip loan, right? Or we would want you to do a conventional loan to acquire and cash out and redo it over
Yeah,
and over.
literally,
But that's not what we're
we're
selling.
li-
We're
we're
selling a
literally
free get your HELOC
incentivized
instead,
to
right?
sell you other loans. Yeah.
Like you get what I'm saying though, right? It's like if
Yeah,
you have
yeah.
the equity, it's like are you smart enough to use it the right way? And like this is where like I think we differentiate ourselves from a lot of people out there because we're not going to tell you to get a program or product that doesn't make sense. Like if there's a better way to do it for you financially, we're gonna point you in that direction. So
I mean, this goes back to why Jason and I started this. Like, Jason, the reason why you started mortgage industry in the first place and why I decided to come on YouTube and, show my face to the world with you is because we want to help people. Is we want people to figure out a better or help people figure out a better situation for themselves. It so like a HELOC, you pay the broker one time and you get to reuse that money. It's a line of credit. So you get to cycle that money back and forth.
it's a one-time loan cost, not every time you need 200 grand for a fix and flip, you're paying all of those loan costs over and over and over again for every deal you do. So if you do 2-3 deals a year and you flip fast, that's where a HELOC becomes that becomes additional profit for you, because if you're not I'm just using a round number of like 5% on 200 grand is 10 grand, and you go through 2 or 3 of those loans a year, that's your margin you're losing out on, right? Again, it just depends on the opportunity and the right investor.
Also depends on how much equity you have in your house. Also depends on if you qualify for the HELOC, right? The other program depends on the target property, whereas a HELOC depends on the actual home that you live in, the primary residence. If you
And you have to
if you don't have
qualify
enough
for.
Yeah, if you don't have enough equity in your home in order to draw out enough cash, then HELOC might not be the route to go for a larger
Mhm.
project. But if it makes sense, then you can use that link in the description to talk to Jason or Nikki, schedule a call with the Clear Close team for your HELOC, what rate you can qualify for, and if it makes sense for you in your particular situation. Let's move on to the fifth product. This is an FHA or VA multi-unit owner-occupied loan. So that's a lot of words. It's actually two different programs. It's an FHA loan for a multi-unit owner-occupied. That means you have to live in that duplex or that quadplex. You rent out the other units and you live in one of the units. You could do that through the FHA or you can do that through the VA. So VA is obviously for veterans. If you're not a veteran, you can't do the VA, but everyone else can do the FHA.
It's actually a really great opportunity, because there's no other loan program out there if you're a veteran. Like as a veteran, you can buy a 2 to 4 unit property with no money down, which is insane. And then you can use those VA benefits to acquire that property, live in it, rent out the other units. And I've seen a lot of cases like where those tenants are paying your whole mortgage and then some, right? Because those other 2, 3 units are penciling out a very high return. Same with FHA, because this program is another amazing government-backed program. It's through Ginnie Mae. You only have to put 3.5% down on this program. So how amazing is it that you can get $1 million rental property for 35 grand down, right? If you
Mm.
found the right one. Another guy in Southern Texas, I know I've helped him multiple times. He bought one duplex, then a quadplex, and then he grew out of that quadplex and bought a single family home. So it's like in 3 homes, he's got 6 rental incomes because the duplex and the quadplex.
Yeah, the pro of having a duplex, triplex, or a quadplex is that all your tenants are like right there. You don't have to drive across the city and fix the properties. Like, it takes a lot of time and energy. If they're all in one building, it's relatively easy. But then the con of it is like they're literally all in one building. Right? If something happens to that building, like there's a flood, an earthquake, something damages it naturally, that's
But
three
that's like
tenants
any
or
home
two.
though, right? You're gonna
But
always
that's
have,
the risk of doing business.
like, even living in your own home, like it's always gonna be a struggle because you always have something breaking, right? Like
That's
I
true.
feel like I'm always out there doing something in my backyard. Not because I want to be out there, but it's like I'm always cleaning something up, fixing it, or trying to stop it from falling over.
Yeah, my kids are like, my son, he's very young. He goes, Dad, it's hard. Yeah, it's hard to brush your teeth. I know. What's the consequences if you don't brush your teeth, man? Like, yeah, he's like, Dad, I'm scared. I'm scared. Like, I know we're all scared. We're all scared of things that could happen to us. But if you don't know how to shower by yourself because you're afraid of monsters coming at you in the shower, like, What are you gonna do when you're 15 years old, man? You want mommy and daddy to stand in the shower with you?
No, you got problems. I'm sorry. That's if that's happening, you got some problems there.
I know. Yeah. I mean,
No
it's the
judgment.
same thing. Just scale that out to business, right? Like, yeah, I'm scared of running my own business. I'm scared of if
Mm.
I buy this home, like a flood will happen. Like, yeah, anything can happen. Really, anything can happen. But if you don't do
Nothing
it, then
good is
you'll,
easy, right?
yeah.
That's right. Nothing good is easy. No, having healthy teeth is not an easy thing. You got to brush your teeth and floss every day,
Like,
right?
listen, you're never gonna have generational wealth if you don't take any risks. Like, it's just never gonna happen. So if you really are serious about growing your wealth, if you're really serious about, financial freedom and leaving a legacy for your family in terms of property or assets, you're gonna have to take some risks. And the Clear Close, we are here to help you enable and finance these purchases so that you could take a chance on yourself and leave something for your family and grow your own personal wealth.
There's no one size fits all loan. It's the right structure really comes down to your strategy, your timeline, and exit plan. Realistically, right? You're out there on YouTube trying to learn as much as possible, right? And then you have to discern who it is that you want to work with. And I've personally helped hundreds of people and investors like structure the right financing to scale their real estate portfolios. And again, so just some of the stuff that I've done in the past, I've managed one of the highest performing mortgage teams at a national direct lender, funded $1 billion just in that year alone. And this is what we do every day. Nikki, Peter, and I, we come together, we help clients like you make the best financial decisions and strategic decisions to use the right loans and programs to help you build that portfolio. And as far as Nikki, she has such extensive experience, over 20 years and over $1 billion in personally funded loans. So we know how to help people acquire not just their first rental property, but or starting from the first rental property to a whole portfolio. So we look forward to helping you.
All right. We have one more bonus product for everyone. So this is for our friends overseas. If you're watching this in I know we have some people that watch us in the UK, in Korea, and we have like a random person in Africa that watches us. Maybe they're spoofing their IP address. I don't know. But bonus for foreign nationals, you are able to purchase a home in the United States even though you are not a citizen. And I'm sure you probably already know this, but this is called a foreign national loan. So, Jason, obviously, we are able to provide products for people who are not in the United States. What would be the process? How can people start other than clicking in the link to get in contact with us?
If you are first off, you got to figure out, are you really a foreign national, right? Because if you don't live in the US and you're watching from Korea or Europe or wherever you are, Africa, as long as you're not a US citizen and you have capital you want to invest, there is a loan program out there for you. It's a DSCR loan, basically, with overlays for foreign national investors. So basically, it allows anyone who doesn't reside in the US, is not a citizen, does not have a visa or right to live fully in the US. It gives you the ability to invest into real estate in the US. So it's basically we're looking at the property and your assets and not your foreign income to qualify you. So you don't have to put out $2 million on a duplex here in Orange County, or say you want a short-term vacation rental in Florida or in the mountains because you like skiing in Colorado. So there's no U.S. credit involved, no U.S. taxes. Instead, we use the foreign national guidelines as long as you have the money to put down to acquire that property. And as long as that loan can be covered through the debt service, then we should be able to help you with acquiring this property.
Those are the five, let's say six products that you can use to finance your first rental or your first investment property. Um, and if you have any questions concerning these things, once again, the comment section is there for you. If you have anything sensitive that you want to talk about with us, including rates, like that has to be individual. You definitely use the links in the description to schedule a call with us. We hope you guys got a lot out of this video, and please share it with somebody who you know is thinking about getting into real estate as a business or an investment. Maybe this video will inspire them. Maybe this video will help them figure out a path to the eventual goal. So once again, we're the Clear Close. Thanks for watching, and we'll see you guys on the next one.